Hey, thank you so much, everybody, for signing up and coming to be here today. We are really excited to go ahead and get started. I do want to allow just a few more buffer minutes for those that are still joining. So I will get back here in maybe 2 minutes or so, and we will go ahead and get started then. Okay, so thank you all again, and welcome to those that are just joining. Again, we are really excited to dive into this webinar today on bridging the gap in unleashing sustainable investments. We have some pretty interesting content here for you today, and we are hoping that this discussion will continue into a longer conversation on sustainable investments and, in general, aligning capital flow with sustainable objectives. So first of all, my name is Emily Block. I am a climate change and sustainability consultant here at CEMAsys, currently working from our Boston office. And I've gotten to gain so much experience here at CEMAsys in the world of consulting in general as well, specifically dealing a lot with investor reporting. We are finding this to be a very relevant topic for our clients and through discussions with other companies as well, hence the decision to move forward with this webinar. Next. Thank you so much for everyone who has signed up and for being here today. We are really excited to get going. I do want to allow just a few buffer minutes for those that are still joining and signing up. Maybe about 2 minutes or so, we will go ahead and get started. Okay, so thank you again, and welcome to all of those that are just joining here now. We are really excited to dive into our webinar today on bridging the gap in unleashing sustainable investments. We have some pretty interesting content here for you today and are hoping that this discussion will continue into a longer conversation on sustainable investments and aligning capital flow with sustainable objectives. First of all, my name is Emily Block. I am a climate change and sustainability consultant here at CEMAsys, currently working from our Boston office. And I've been able to gain so much experience here at CEMAsys and generally in the world of consulting, specifically though, dealing a lot with investor reporting, because we're finding it to be a very relevant topic for our clients and throughout discussions with other companies, hence the decision to move forward with this as our topic for the webinar today. I will just take us through a quick agenda here. We're going to start by doing a little bit of background on ESG rating and rankings and investor reporting in general. And then we're going to get into the correlation that we may or may not see between ESG efforts and long-term profitability and enterprise value. And then we will lead nicely into the discussion of the gap. So those of you who read the description of the webinar or have heard about this previously, you know what I mean. But for those of you who don't know what the gap is, we will be talking about it quite thoroughly. So don't worry. And then, of course, we will talk about closing the gap as well. In this part of the webinar, the closing the gap, we will consider that from the company perspective, but I think it will still be pretty enlightening for those joining from the investor side as well. And then we will finish up by talking about some of the other benefits that your company may see from ESG reporting outside of pleasing investors. And there are some really helpful benefits here, so a lot of really exciting topics to cover. And we will leave about 10 to 15 minutes or so for a panel discussion where we will discuss what we heard here today and what we talked about, but also we're looking to answer some of your questions. So feel free to ask in the Q&A box throughout the webinar. We'll try to answer in the panel, and if we don't get to it in time, we will either answer it in the chat for you or respond via email. Okay, so before diving too deep into our content, I do want to just take a minute or two to go over some context of who CEMAsys is and what we do. So CEMAsys itself has been one of the leading ESG specialized consultancies in the Nordics. We opened in Norway all the way back in 2007 and have grown exponentially since then. So at this point, we are helping over 800 clients report for over 13,000 different subsidiaries, and this is across 70 different countries or more. And we have seen some recent internal growth as well. So branching from our original Nordic office, we opened Boston back in 2022, and then recently just opened our office in Copenhagen, Denmark. And then we are also opening an office in Stockholm, Sweden before the end of the summer. So it's a lot of really exciting growth happening here at CEMAsys. To give you some more detail on what exactly it is that we do, we have what we like to call our two-pronged approach. So on one side, we have our software, which is our 5 different cloud-based modules that you see at the bottom of the screen here. And these have the ability to bring value to companies in all different parts of ESG. So to go through them really quickly, we have our carbon footprint tool, which does management of emissions and decarbonization. We have our supply chain control module, which does risk management and also can help with supply chain engagement. Our ESG metrics module can help measuring with KPIs and management, and also helps with sustainability reporting. And then our activity logs module deals with materiality management and stakeholder dialogue. And then finally, we have our EU taxonomy module, which does regulatory compliance and eligibility with alignment. And then this works really well in tandem with our second prong, which is the expert consultants. So we as consultants really pride ourselves on being well-rounded, not just in using our own software, but in best practice and internationally used standards and frameworks as well. So some of these you'll see at the top of the screen here. And this expertise allows us to work well, not just with our clients and helping them understand these frameworks and making everything a little bit more comprehensible, but also informing our in-house tech team to continuously improve our software and make sure that it is tailored to not just best practice standards and frameworks, but exactly what our clients need to report in line with regulations and in line with best practice. And this business model has really allowed us to be an all-in-one sustainability provider for our clients. And we will get back to these standards and frameworks that you see on the slide here as we dive into kind of the ins and outs of investor reporting and how companies can best report in line with investor needs. Like I said in my introduction, I do want to spend a minute or two going over the basics of what investor reporting is and how all of these different platforms out there can differ and relate to one another. As I know there are a lot of options out there and it can be a little bit daunting and even confusing, especially when you're starting out. So companies have come up with multiple different ways to communicate what they do within ESG to their stakeholders, and their stakeholders including investors. And this could be an annual report or a sustainability report. It could be a dedicated area of your company website. But recently, investors have really been looking increasingly towards rating and ranking platforms. And this is where companies are rated on a variety of different ESG criteria, and then they are given either a rank or a grade compared to either some preset criteria or compared to other companies in their sector, for example. So there are dozens of platforms out there, and it can definitely be confusing when you're trying to decipher exactly how they differ. So I wanted to present one of the main ways that we like to categorize these platforms, which is the data that they use to evaluate a company's ESG maturity. So first of all, we have the basic data provider, and they will usually utilize publicly available data. So maybe the sources that I mentioned before, so like sustainability reports, annual reports, and company websites. And they will use this data on their end to then create either a rank or a rating for a company's ESG maturity. Bloomberg is a great example of a company or a platform that does this. Next is the comprehensive data provider, which will do the same thing, look at that publicly available data, but then they will combine this with some sort of company questionnaire, some sort of input from the company itself that they're grading. So MSCI, also S&P, great examples of comprehensive data providers. And then finally, we have our specialized data providers. So they are typically very detailed questionnaires that offer in-depth data and a lot of useful information for investors, especially if they're looking to specialize in one of their ESG areas within their portfolio. So CDP is a great example of that. So this was just one way of looking at how platforms differ from each other that can help us kind of understand where the data is coming from. But they can differ in other ways as well. So looking to the right side of the slide here, they might differ by where they're looking in terms of E, S, or G, or maybe looking at ESG holistically. The data could be qualitative or quantitative, or it could be a combination of both. And very importantly, their grading scale and their methodologies for coming up with these grades will change from platform to platform. And this is something that we're going to talk about more further on in the webinar. To put everything into a little bit more context, we do have a pretty expansive reporting landscape in the ESG world. There are a lot of abbreviations and a lot of terminology, and it can definitely get a little bit confusing to think about and daunting when you're first starting out. So we wanted to lay it out a little bit more clearly here. So we have our rating and rankings up in that upper left-hand corner. So MSCI, CDP, EcoVadis, so on and so on. And this is what we were just talking about, right? So these are those third-party platforms that will evaluate your company's ESG performance. They'll gather data and provide either a ranking or a grade that investors can then go look at and include the data in some cases to make investment decisions and make decisions based on this information. But this is not really where it starts in terms of methodology. So many of these rating and ranking platforms are based on other areas within the ESG landscape. So if you look to the right side of the screen, you'll see internationally used frameworks and standards at the bottom that are often used as the basis for these assessments conducted by rating and ranking platforms. So TCFD, for example, this is used as a guide for how you should evaluate climate risk and opportunity. Greenhouse gas protocol, which will give you guidance on calculating your carbon footprint. And then you have standards such as SASB and GRI, which recommend disclosures not only within climate, but also other aspects of the E, S, and G. And then you might have CDP or EcoVadis, for example, asking you to disclose information based on these methodologies described in the frameworks. So you can see kind of how these two different parts of the landscape will work really well together. And then, of course, you also have regulations down in the bottom left, which are increasingly utilizing standards and frameworks to guide requirements when it comes to ESG disclosures all over the world. Of course, the EU is leading on these types of ESG regulations, but we're seeing them pop up in other regions as well. So overall, the ESG landscape works together. And when you're able to get kind of a clear picture of the purpose of all these different areas within it, it can serve as a really helpful guidance on where to start and where to develop your own company's ESG strategy. And then the progress of that ESG strategy can often, hopefully, be well summarized within ESG rating platforms. Okay, so we're going to transition over to talking about ESG and if and how it correlates with long-term enterprise value and the profitability of a company. I wanted to start off this section with a quote from the investor perspective. So this says, "It is our conviction that companies that perform well on ESG are generally less risky, better positioned for the long term, and possibly better prepared for uncertainty." And this is coming from the director of sustainable investing at the third largest Dutch bank. But we see this trend every day in our work as consultants as well. So we hear it from our clients that their investors want to see more of what they are doing in terms of ESG and sustainable strategy. because they're finding it insightful information on how this company will be doing in 15, 20, 50 years down the line even. So we wanted to look a little bit further into this. Does sustainability actually correlate with long-term growth and profitability? And we found a lot of interesting studies that point us in the direction of, yes, this correlation does exist. So to give you a recent example, this graph here shows us the performance of ESG funds, which are in blue, and then non-ESG funds, which are in purple, during the initial economic impact of the pandemic, the COVID-19 pandemic. So they break it up by passive and active funds, and then also regionally. But as you can see, these axes are negative. So the longer stretching purple bars are indicating that the non-ESG reduced more so than the companies that had worked on their ESG. So the ESG companies saw a more conservative loss. So the next logical question to ask might be, why are we seeing ESG funds decreasing less in an economic environment like the one that the pandemic produced? Well, first of all, part of considering your ESG's impacts and risks means that you have taken a look at your long-term strategic outlook. And once you've considered your business activities across the entire supply chain and into the future, you have that better overall understanding of your strategic outlook into the future. You have also therefore increased your awareness of these risks and opportunities that are relevant to your business. So we talked about this a little bit earlier, right? We mentioned TCFD and climate risk. And this is something that investors are really looking to see. They want to know if you have considered that a supplier is, for example, in a high flood risk area, and therefore you have set up secondary suppliers in case of a flooding event so that you can divert that kind of negative economic impact from a climate risk. So just one example of how risk and opportunity awareness can translate into doing better as a company. Additionally, most best practice standards and frameworks are going to ask you to consider your governance structure. So not only has your company considered your risks and opportunities, but do you have the relevant policies and people in place to then integrate the findings into your strategy? So do you actually consider your climate considerations in that standard financial risk assessment that you're already doing? By having a well-rounded ESG strategy, you're just really showing your investors that you've considered your governance structure, and that is one, hopefully, that is ready to respond to a quickly changing environment. And finally, by measuring your emissions, along with any other ESG data that you might be interested in, you're able to improve your operational efficiency, which can therefore improve your bottom line, which investors are going to want to see, of course. And this might just translate through maybe a lower energy bill, but in general, being aware of your impact and where your large drains of resources and energies are going, this can really have a significant financial benefit for your company. So overall, the general takeaway is that yes, for these reasons here, we see a correlation between companies who consider ESG important and companies who do financially well. I do feel that we need to acknowledge, however, that there is the issue of correlation and causation. In other words, is there actually this intrinsic value of the ESG work that is producing this type of evidence that you see here? Or is it another factor that is simply influencing the data and making it present to us like this? So for example, you could argue that companies who are already doing well have the space to grow within ESG. They have the time and the funds and the people, and then this is why we're seeing this trend. Or you might argue that investors are looking for ESG related funds because of a push from consumers to be more conscious, and therefore companies are receiving the capital and experiencing financial success. And while I would personally argue that the 4 explanations that you see on the slide here for why companies may do better when considering ESG, I think they hold enough weight for us to say that there's likely at least some causation that exists rather than just purely correlation. We do think that it is a fair point and definitely a fair debate to have on this topic. But either way, we're seeing a lot of cases where there is a correlation between ESG and profitability, and investors are noticing this as well. So whether or not you agree that there is a causation between ESG and long-term value, investors have been really clear on their preference to have this type of information available to them. And they have very frequent use patterns for this specific type of ESG-related data. So if you look on the screen here, you see as of 2022, 99% of investors reported to have been using some sort of ESG disclosures from companies somewhere in their decision-making process. To add to this, 82% of corporate representatives listed investor demand in their top 3 reasons for engaging with ESG raters. And then finally, we have the fact that 43% of investors were required by employers in 2022 to integrate ESG ratings and data into their investment strategies. And just to emphasize the growth in this demand, this number was only 12% in the same exact survey conducted back in 2019. So it is pretty clear that there's a high demand for ESG information and an increased use in these rating platforms. And this demand has been reflected in regulations as well. So in addition to CSRD and the EU taxonomy, which both require disclosures of sustainability-related information, specifically focusing on the financial sector, we have seen similar trends emerging in North America. So you have OSFI's passing of the climate disclosures in Canada, and then we also have the SEC's proposed climate rules, which were set to be released back in April, but we're now expecting them closer to kind of the end of summer. But both of these North American regulations would require companies to disclose information pertaining to sustainability, more specifically their climate risks, in order to further inform investors. So all in all, this paints a really nice picture of the relationship between sustainability and future development, right? Looking at these stats, it would make a lot of sense to conclude that investors are sending their funds in the direction of sustainable businesses, and those who adapt and mitigate to climate risks will do well, and the money will flow in the same direction of what we at least consider to be widely accepted societal goals, so addressing climate change and biodiversity loss, human rights violations, and so on. And when the economic benefits are matching up with the direction of societal goals that we want to go in, we have a perfect kind of hands-free solution to these problems, right? But unfortunately, there seems to be some gaps in this theory and some gaps in the path to sustainable development into the future, which brings us to the discussion that is kind of the main focus of the webinar today, which is the gap between investors and company action. So we'll move on to this discussion of the gap and why we might not see the perfect flow of funds from investors to sustainable businesses and therefore sustainable development in the future. Studies and surveys have shown us that there is not perfect alignment between what investors are asking for and what companies are feeling incentivized to do from investors. So in a study by Ernst & Young back in 2022, it was found that 78% of investors say they want companies to make investments in ESG, even if that means a cut to their short-term profits, which is great, right? This matches up really well with the findings that we just went over. But we also have the stat that says more than half, 53%, of corporate representatives are facing short-term earning pressures from investors. And this is then disincentivizing them from making these sort of long-term investments in their sustainability. And I find that to be really telling, right? This shows us that there is a miscommunication occurring between businesses and investors. And this can pose a big threat, not just to companies looking to maintain funds, but it shows us that we might be facing a misallocation of funds. So investors have massive influence on where our development is going to take place in the future in terms of infrastructure and technology and so on. But this gap indicates that the capital flow from investors may not be in the most economical path right now if sustainable businesses are not able to be recognized. And this capital flow may be in the wrong direction in terms of solving those overarching problems that are societal goals that we talked about before. So let's dig into why this gap exists and what are investors saying in terms of why they may not be able to recognize or trust when a company claims to be sustainable or tries to communicate their sustainability strategy. So we'll see here that according to the same survey, 80% of investors say that too many companies are failing to properly articulate their rationale for long-term investments in sustainability. And this is making it difficult for the investor to evaluate that investment. So there's a point of miscommunication from the investor side, right? They may be seeing these claims of sustainable investment, but the rationale is missing and they're failing to get a picture of their long-term sustainability strategy that the companies have in their mind. And then we also have the fact that 73% of investors say that organizations have largely failed to provide enhanced reporting. So they're looking for companies to incorporate ESG disclosures in with their normal financial disclosures. And this has been a really big point of conversation recently. Investors are looking for the same consistency and standards for ESG information that they're currently receiving for their financial information. And the regulations and the consensus on kind of the best way to measure and communicate ESG just doesn't exist yet, which might be a secondary reason for this gap to exist, where companies are not satisfying investor needs for information, and there's no comparability for between companies, which is making it, again, difficult for investors to evaluate. A possible compounding issue for this is that we're seeing an increased use of ESG rating platforms by both investors and companies, but on the other side, we're seeing a corresponding decrease in trust for these same platforms. The quality rating for ESG ratings in general dropped 13% from 2019 to 2022, based on the 2022 Rate the Raters survey. And this is with 76% of investors reporting they find companies are being highly selective with what information they're providing to investors through these platforms. And this is resulting in concerns for greenwashing. And these hesitations are definitely not unfounded. There are several examples from the last few years where companies were rated either moderate or even high on these ranking platforms, but then faced scandals relating to risk management, corruption, human rights issues, etc., and resulting in a loss of funds for investors. So one example is the Brumadinho Dam collapse back in 2019, which was found to have been caused by a lack of risk management and safety protocols, as well as governance within the operating company Vail. But Vail had been ranked pretty highly on several of these platforms. And then we also have Winecard, which is a German payment processor and financial service provider, which back in 2020 was rated pretty well on a lot of these rating platforms, again, moderate to high. And they were found to have been engaging in widespread fraud, which resulted in significant financial loss for their investors. So despite high and increasing usage, investors and corporate representatives seem to be frustrated by the shortcomings of these ESG ratings that are currently available. In addition to greenwashing fears, investors are also citing inconsistencies between the rating platforms as one of the biggest reasons for uncertainty, which is not just inconvenient for investors, but if this trend continued, it could threaten the credibility of these ratings in a time where they are really essential for the development of our economy. Because as we know, this uncertainty can lead to higher perceived risk, higher market premiums, and then lower investor demand for companies who, may be attempting to demonstrate their sustainability. But why are we seeing this inconsistency between rating platforms? Well, first of all, most rating platforms have different objectives. So maybe in different intended users, different guiding principles or target audiences. Also, some platforms may prioritize transparency while others reward performance and outcomes. And this can be a point of confusion for the consumers of the ESG rating and rankings. So a good score on these rating and rankings does not always correlate with a company who is necessarily sustainable or good for the environment. Some assessments may just be looking for transparency. Some look for ambition. Some look for governance setup so that you're able to actually meet your ambitious goals. CDP, for example, looks at how ambitious your targets are, and now looks that you're actually reducing in line with these targets. But an A on CDP may not specifically mean that you at this exact moment are a sustainable company. Also, as we talked about earlier today, they could diverge in the way that they assess companies. So some being based off of questionnaires, while others rely on publicly available data. Assessments may also differ by if they're sector specific or not. Also, the level of verification and validation that they require will all differ from platform to platform. And finally, we use, some would argue, the most importantly, different scoring methodologies between these different platforms. And this means that some might use an absolute score while others are relative, but also the criteria and the weighting of different topics will differ depending on the objectives and the assessment. So also the focus topics, the target audience, etc. And these scoring methodologies differ from case to case, and they will lead to the variation of company scores across different platforms. And while this may make sense to us now, because we understand how these different platforms differ in terms of how they grade a company, it can create doubt and uncertainty for investors, especially if they're unfamiliar with the platforms, their objectives, and their scoring methodologies. And this lack of standardization and data reliability and accuracy, also conflicting data ratings, makes it really difficult for investors to compare and interpret the ratings effectively. And this could render them pretty useless in a time where they and their utilization is not just growing in popularity, but is needed. And like we've talked about, to align the direction of the economy with these long-term societal interests. I do want to add here, though, that there are emerging regulations, specifically in the EU, that are aiming to address the inconsistencies and the lack of data assurance by giving them a little bit more oversight and some more requirements in terms of what they can and can't include in their scoring methodologies. And these regulations are definitely going to be helpful in addressing these issues that we're talking about today. But while they're still pending, we do want to talk about what we can do now to gain back some of that investor trust in these ESG rating and rankings. So these issues that we just highlighted really require a combined effort from all stakeholders. So regulating bodies, the rating agencies themselves, investors, but also the companies to really address and remedy these gaps. And for today, like I said, want to focus on the company perspective on how companies can do their best to close this gap that we just talked about. How do we improve trust in these rating platforms and make investors feel more comfortable with companies' sustainable investments? So we need to hear what investors are telling us in terms of why this mistrust is growing. And as we already know, like I've said, 80% of investors say that companies are failing to articulate their rationale for sustainable investments. And without a long-term view of your strategy, investors are going to lack the confidence needed to keep from reacting to your short-term losses when you invest in sustainability. So let's take a look at the top 3 reasons for investor mistrust as reported in the 2022 EY survey that we talked about before. So on the right side of the screen here, we see the top 3 reasons. We have absence of assurance and evidence, a disconnect between financial reporting and ESG disclosures, and a lack of insight into strategy for long-term value creation. And all of these areas can be addressed by developing a thorough ESG strategy and effective communication of that strategy. And based on these, we've outlined some key points that we believe will be effective in gaining investor trust when it comes to ESG reporting. I do want to acknowledge first, however, that investors will also have to play a major role in this, as we see this as an emerging topic and the science is developing very rapidly. As we learn more and kind of advance our methodology and calculations, it is important for investors to kind of do their part and keep up with this so that they can then better understand what companies are trying to articulate and trying to communicate in terms of sustainability. But from the company side, it will be vital to focus on clearly articulating the rationale behind your long-term investments. And having a robust ESG strategy is one thing, but being able to communicate it with stakeholders is what is really going to make that difference in terms of investor trust. It is essential to improve how your organization communicates in order to have investors understand that long-term strategy that you're envisioning. We also believe that providing maximum transparency will encourage your investors to look past any short-term losses, as they will hopefully feel a little bit more confident and comfortable with their knowledge of your business operations. So this includes disclosing all metrics, targets, progress towards sustainability goals, and aligning with these widely recognized frameworks, which can help provide investors with that comparability and that standardization that they're looking for. So overall, just having a robust and best practice reporting strategy. Also, ensuring the accuracy and reliability of ESG data is also going to be essential. So your company should have a robust internal process and system in place to collect, verify, and validate ESG data. So going that step further and engage external auditors, get the specialized third-party verification, so that you can add a little bit more credibility to your reported information and kind of raise that level of trust even further. Companies can also actively engage with investors to understand where their hesitations are coming from. So the underlying reasons that mistrust are presented here today, these are all very broad because the specifics for investor hesitation is going to differ by geography, sector, the type of investor that you're dealing with. So by really engaging with your investors and understanding where they're coming from, this will provide some sort of additional context and clarity and allow you to address any questions or doubt in terms of your sustainability performance. And finally, a strong governance practice will play a vital role in building trust with investors. So companies should ensure that their boards have appropriate oversight over ESG matters, including clear responsibilities and reporting structures. Integrating ESG considerations into board discussions and decision-making processes will tell your investors that you are committed to long-term sustainability. I also think it's important that we highlight this reoccurring theme that we keep seeing of investors wanting climate information in the same vein as financial information. They want it to be comparable and consistent and also high quality. They want to see that these companies are using scenario analysis and involving high levels of the organization, and they want these risk analyses built into the normal risk assessment that your company is already doing for its financial planning. And this plays into the goal of having a more comparable and consistent ESG disclosure process. But I wanted to take a look at how companies and investors view the individual rating and ranking platforms. So as you see, these are some of the results of the 2022 Rate the Raters survey, in which corporate representatives seen in the dark blue and investors that are seen in the light blue have ranked the different platforms on their quality and usefulness. You see 4 selections here, but these are just the top 4. The survey actually asked them to rank 13 of the most widely used platforms. And I think this information can be especially useful for companies that are expected to engage more and more with rating and ranking platforms. Companies are going to have to start prioritizing their spending and their resources, and understanding which platforms hold the most value for investors may help with that selection process. And understanding these platforms' methodologies and their priorities will also help companies score well across the board with these. So we wanted to focus our discussion, therefore, primarily on the platforms that rated highest on the investor side. And as you can see, CDP is really high up on everyone's list for both quality and usefulness. So we're going to dive a little bit deeper into some of these platforms on the coming slide, but looking specifically again to the investor side, we see ISS ESG ranked quite high in investor quality and usefulness. Interestingly, not ranked high on at least the top 4 for the corporate side. And then finally, we also see Sustainalytics pretty consistently high throughout these ratings. So we're going to dive into the specific methodologies of these 3 platforms, but I do want to emphasize that we are not advising companies to focus solely on these three platforms in terms of effectiveness or effort or resources. But we do feel that getting into the specifics of these could help companies understand the investor perspective and report accordingly with all of the available information. So with that being said, let's check out some of the details on CDP, ISS ESG, and Sustainalytics. So for those of you unfamiliar with the CDP, it is a global disclosure platform where companies, cities, and also regions can disclose their environmental and impacts and risks. And a company may be requested to respond to any of the 3 or 4, if you're a city, questionnaires listed at the bottom of the slide here, which includes climate, water, and forest, and cities, if you're a city. So the CDP is a rating rather than a ranking, meaning that you are going to be receiving a grade based on an absolute scale, and your grade is therefore not influenced by other companies and their performance on this questionnaire. The CDP grades, categorized as A, B, C, D, or F, represent a level of your company's environmental performance and also disclosure. So the A is the highest score, obviously, and this indicates a leadership in the climate solution. So you have robust data, comprehensive disclosures, so on. And then a D- indicates a lower score with room for improvement in all of these areas. And then an F is rewarded in the case of failure to respond. So the CDP looks holistically, but at environmental issues in particular. And again, this is a very thorough questionnaire where your company can disclose on emissions, risks and opportunities, strategy development, targets, progress towards them, and so on and so on. A lot of different categories, a very expansive questionnaire. And in this way, the CDP is able to benchmark companies against each other and provide investors with an overall assessment of environmental performance, but also transparency and the management of climate risks, and also the implementation of sustainable practices. So one reason that I believe explains kind of the high rankings that you see for CDP shown on the previous slide is that they have a relatively strict list of criteria that lets you be eligible for an A grade. And some of the criteria you can see listed on the right side of the slide here. This is specific to the 2023 climate questionnaire. And each year, this criteria can change, and this raises that minimum bar for what would qualify a company to receive an A. And this means that companies who stay static and don't evolve with kind of the changing methodologies and scientific findings will not be able to remain on this A list. And in this way, investors also automatically know that certain aspects of a company exist in their strategy just by looking at the letter grade. So if you have an A on CDP Climate for 2023, for example, they know that you have an SBTI approved target as well as a net zero target. They know that you get your emissions verified, that you have a publicly available transition plan, and that you engage with suppliers. And additionally, I think a secondary reason for it rating quite high in terms of usefulness and quality is that their methodology is published and it's clear. So for each question in the questionnaire, you can find a corresponding guidance and scoring methodology. And also every category within the questionnaire has a very clear weighting. So overall, this platform is able to provide some really reliable information and data to investors, and it clearly instills a little bit more confidence in the answers provided. So moving on to ISS ESG, this was rated number 1 for investor quality and 2 for investor usefulness. So while not a lot of showing on the company side for the top 4, we know that this rating platform is relevant to investors. So ISS ESG aims to provide investors with relevant and material ESG data and assessments, specifically looking at how ESG risks and opportunities and impacts play out along their entire value chain. So this includes employees, suppliers, customers, and communities that you see on the bottom of the slide here. And the rating ranges from a D- to an A+, and this is based on over 30 different ESG topics were assessed for all companies, and then there's an additional 100 or so factors that play into the final rating score that are sector specific. And this grade is also divided into categories, which include environmental management, social impact, labor practices, corporate governance, and business ethics. But the specific weightings of these categories will depend on the sector that you're in. The assessment is based on a combination of quantitative analysis and publicly available data, including quantitative metrics, and they also engage with the dialogue with the company while evaluating their score. So as you can see from these categories that they take into account, this is a more holistic analysis of ESG overall, rather than how CDP just focuses on climate. And in terms of benchmarking, ISS ESG is able to provide comparison to competitors because they have these sector-specific metrics, and they're looking to create this kind of sector-specific grade for companies, so maybe a little bit more useful in terms of benchmarking within sectors. All right, and then finally moving on to Sustainalytics. So this is very similar to ISS in a lot of ways. They do both look holistically at ESG, but Sustainalytics is very specific to ESG risk and also the management of those risks. So the rating score goes from 1 to 100. And this is meant to reflect how much of a company's exposure to risk is unmanaged. So in this case, the more risk that is unmanaged, the higher your score. So you don't want anywhere close to a 100. And this score is then used to place a company into any of the categories that you see here. So negligible, low, medium, high, and severe risk levels. Also, Sustainalytics gets their score from both the mainly publicly available data, such as websites and reports, but also information is gathered through direct communication with the company as well. So again, similar to ISS. They additionally, though, perform reviews of media and NGO sources, and also Sustainalytics and ISS will both look to disclosures within the CDP for their assessments as well. The final score is then a reflection of governance issues, material ESG issues, which they call MEIs, and then what they call event-driven risks, which are risks that may emerge due to a severe ESG controversy. And then in terms of benchmarking, the scores provided allow investors insights into the level of unmanaged risk within a company. And their scores are determined based on a specific criteria, which are those MEIs, material ESG issues that I talked about, but those will all differ by sector. So Sustainalytics has specified MEIs for 138 sub-industry classifications. So this makes it even a little bit easier for companies to be compared with their competitors and make it a little bit more sector specific for those trying to analyze their scores. Transitioning now, I do want to emphasize some of the other reasons to develop a robust reporting strategy. Throughout this webinar, we've talked about seeing this correlation between financial success and ESG reporting. So outside of gaining capital from investors, I wanted to talk about some of the other reasons in detail that a company can see success in all areas of the business from considering ESG impact and risks. First of all, we have mentioned this briefly before, but reporting can give you a starting point for where to progress your ESG strategy. In general, reporting with ESG allows for increased engagement, which really opens up the door for useful feedback from stakeholders and can create a useful roadmap on exactly where your sustainable strategy is lacking and how to fill those holes. So reporting to the platforms like CDP, for example, this will highlight the gaps in your current strategy, and this can then serve as a really valuable guide for mapping out, kind of understanding where you are now, seeing what best practice looks like, and then seeing exactly how to get to that point. We talk to our clients about this all the time because we feel that reporting to the most extent possible can really point companies in the right direction and answer that question that they're already asking us, which is how do we get started, or what is the next step that we need to take to strengthen our strategy? Another reason for reporting and the benefits that come with it are that we are headed for a transition to a low carbon economy. And if countries and regions such as the EU are going to make it anywhere near their future goals of net zero, companies are going to have to take part in that transition. So there's currently more than 70 countries that are a part of the net zero coalition, and this includes China, the US, and the EU. And they have all set net zero targets covering about 76% of global emissions. And with all of this, companies are expected to keep up with the reductions and report all calculated emissions and commit to these targets that they're talking about and actually start reaching them through low carbon transition planning, and they're going to have to report on all of this progress. And we've touched about this last part a little bit, but because of the investor demand for ESG disclosures, countries have been mandating the disclosure of this information. And while we have these regulations with kind of longer timelines, in order to comply, companies need to start collecting and reporting information now. And this includes companies within the EU, but also Canada and the US and all over the world. And these regulations are highly based on already available standards and frameworks like the ones we've already talked about today, meaning that companies with a robust best practice reporting strategy are already going to be ahead of the game in terms of this legislation when it does get passed and put in place. Okay, so to put everything kind of into one slide here together for us, I wanted to kind of give you a little bit of a summary. So we have this problem in the way that our reporting is currently operating. There's a disconnect between what investors say they want from companies and what companies are saying they are being incentivized to do. Investors are reacting to this short-term profit drop, and this is making it increasingly hard for companies to invest in their long-term sustainability strategy. So what's the cause? Investors are saying that companies are failing to help them understand these long-term strategies. And this is then paired with a distrust in the rating and ranking platforms that are supposed to point investors in the right direction. And investors are then becoming unable to align their capital flow with sustainable business. And this is bad for investors who want to invest in sustainable business because they believe it is more resilient. It's also bad for companies who are trying to become more sustainable because they're feeling restricted by investors. And then finally, it's bad for those societal goals that are not going to receive the development funding required from that public sector in order to fully address them. So what are investors saying in terms of how we can solve this? Well, they want to see more assurance for data accuracy, a more complete disclosure of metrics and data, maybe even some third-party verification. They want to see ESG disclosures being as comparable and consistent as their financial disclosures. And finally, they want better communication from companies on their long-term sustainability strategy. Therefore, it is our general consensus that by creating a well-rounded communication strategy guided by transparent and accurate reporting, companies will be able to improve with investors within their engagement, strengthen their governance as well, and together this can increase trust and encourage investors to look past short-term losses from sustainable investments. And finally, reporting will help improve performance overall by, yes, receiving more funds from investors, but also keeping up with the low carbon transition and anticipating upcoming regulations as well. So that is all I had for you in terms of this content, but we definitely don't want the discussion to end there. We have left some time at the end for some further discussion, and I just want to jump right into that with the time that we have left. All right, so I'm just going to hop off real quick and give them a chance to get their videos up and running, and then we will go ahead and get started as I look through some of these questions that were submitted.